Well, first, let me throw out the history of that one because I did bother to look it up. That term is about 100 years old, and it comes from turn-of-the-century poker chip sets. And the blue chips were the highest valued.
You're listening to IBKR's Sense of Security. Find more conversations at ibkrpodcast.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Welcome back to the Sense of Securities podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers. Today, I'm your host for our podcast, and our guest is Steve Sosnick, Chief Strategist here at Interactive Brokers. We're going to discuss financial market jargon, and we hear it all the time on the news, and we read it in the headlines. But where did these popular terms come from, and what do they mean? Welcome to the program, Steve.
Thanks, Cassidy. It's a pleasure to join you.
Great. So for the listeners that don't know, could you tell us a little bit about your background in the industry?
Yep. I've been at it probably since long before many of the listeners were born. I started in the late 80s at Salomon Brothers. If you've ever read the book Liar's Poker, that occurred about a year or so before I joined that firm. I was a proprietary trader there as well. I also did stints at Lehman Brothers and Morgan Stanley until I joined the predecessor firm for Interactive Brokers, which was called Timber Hill, which was an options market making firm. And I joined there in 1995, I believe. And basically, we traded options and stocks and futures and all sorts of financial products for many years. And then somehow, through some twist of fate, I became allowed to talk to the press. And so my role changed from proprietary trader, which while I was doing this, we stopped proprietary trading in a big way. We got out of that business. And I became really a talking head, putting all those years of experience, hopefully, to work for people.
Well, that's perfect for today's topic because I'm sure you have a lot of experience with all of these phrases and these words. But a little thing for myself, when I first started here at Interactive Brokers, I started with editing some of your commentary videos and helping do some of the optimization on the content and writing some of the questions. And initially, out of college, while I had the business degree and the understanding of a lot of the terms, there were times where I got into the media room and just heard words I had never heard before. One of them we're going to talk about, like dead cat bounce. I heard a bunch of people talking about this, and first I was concerned, then I wasn't sure. So I was like, all right, let me Google this before I just decide to make up my own definition for what I think this is. But for the most part, I was hearing this financial market jargon more and more every day with the content that I interacted with on the campus or Traders Insight. And those were mainly economists, head traders, or journalists, but usually,
or me,
or you, right, or my coworkers, yes. But from that perspective, like I was seeing it firsthand from my job. But for the general public, where would they be hearing the common financial market jargon, and like who are the usual people that will use them, that are more of the, we'll say, well-seasoned people who are using these phrases every day?
Yeah, I mean, I think it's important because these terms get thrown around a lot. Most of them have made it into, general media, certainly financial media. They get thrown around in social media a lot. I think misused a certain amount of time on social media. And so it's important to understand what people are talking about and because it'll give you a deeper understanding of the markets. Any business that has very specialized techniques or specialized products develops its own jargon. In this case, it's a business that has a lot of specialization, but also is accessible to the general public. And so I think it's important that you bring this kind of intersection to people's attention.
And I'm sure with today's day and age, with how easy it is to access information or just see it on social media and so on and so forth, it's important to understand what this lingo is, because as you go further in life, you're likely going to interact with other types of investment opportunities or investment risk, and kind of knowing the talk for it is very important, because sometimes things will sound scarier than they actually are, nicer than they actually are, or like cute, and you're actually not in a cute setup. It's not a great situation.
There's a lot of gallows humor that persists on trading desks.
Exactly.
And so a lot of terminology that sounds awful is really benign and vice versa. And also remember, because these terms get misinterpreted, it's important to know your source and to get the definitions from a reputable source. And I'd like to think we are a reputable source, you and I, rather than sometimes getting misapplied knowledge by people who have a vested interest in misapplying.
Really, we're looking at some common market items, a couple of, we'll say like other names for stocks and stock groups, some market views, and then finally some economic growth and economic policy phrases. So the first two, which are like Finance 101, Business School 101, is the bear market versus the bull market. So if you were in the classroom with the Finance 101 students, how would you describe those two to them?
Fairly simply, a bull market is one that's rising and investor psychology is positive. A bear market is where it tends to be one that's falling and investor psychology is negative. And the psychology tends to go hand in hand with the motion of the market. People tend to feel good when markets go up. They tend to feel rotten when markets go down. It's funny because I've been using these terms forever. These terms have been used forever. And I actually looked them up because I was like, where did these come from? I've been using them for so long, and I was afraid that I would sound like Ron Burgundy when I'm like, oh, no one knows the names of these terms. It's lost to history. And then you'd correct me with something really silly and obvious. But there really isn't a consensus where it comes from. One school of thought is bulls, when they charge and they point their horns upwards, and bears, when they attack, they swipe downwards. Maybe. There's some school of thought that it had to do with like the fur trade, that that a lot of fur trappers would sell the bear skins before they had them, and so they would hope the price would that they sold at a high price and buy it back later. None of these are really satisfying. It just sort of, these terms have just become so generally accepted to be bullish and bearish, but these are truly, I think, lost to history.
So those generally, bear going down, swiping down, bull going up, pointing up. That's kind of the really, really boiled down version of those terms, I would assume. But the next one is something that I heard a lot in my business capstone course, which is a blue chip stock. And those, as far as I know, are more of like the established, highly valued companies. So like, what are some of those ubiquitous blue chip stocks that are always, the crown jewels that are up on financial media?
Well, first, let me throw out the history of that one because I did bother to
go
look it up.
for it.
That term is about 100 years old, and it comes from turn of the century poker chip sets. And the blue chips were the highest valued, as opposed to the white or the red. So you had fewer blue chips in a round, if you can imagine that sort of round poker chip holder. And that's where the term supposedly comes from. And that one, I do actually believe that that's the case. Because they were the most valuable stocks on the board at the time. Now, blue chip has evolved somewhat. These are sort of the perennial best in class type of companies. It doesn't necessarily mean the highest price company because, as I'm sure you'll discuss at length in other podcasts, the price of something does not necessarily, in a stock market sense, reflect its value per se. You can have some divergences. So, but in general, if I gave the listeners enough time to come up with a list of blue chip stocks, I'm sure they could. Apple, Microsoft, JP Morgan, Goldman Sachs, Boeing, these are and take it from the list. They're sort of market leading companies, generally with a bit of a pedigree. And that pedigree, in some cases that pedigree is hundreds of years old. In some cases it's measured more in decades. But that, I think, is the way to think about it. It's a fairly, I will say it's a fairly nebulous term. There's no definition of what the blue chips are. In general, you could think of the stocks that are in the 30 stocks that are in the Dow Jones as blue chips. To another extent, you could think of the 500 stocks that are in the S&P 500 as blue chips. But there's no real established list of what all the blue chips are. It's you just sort of a catch.
Got it. So it's more about the business as the business's track record, kind of being
Yeah.
more established than just the flash in the pan type companies. They have a little bit longer of a standing.
Think of I'm thinking now of like drug stocks where, Merck, Johnson & Johnson, Pfizer are considered the blue chips. There are also a whole bunch of smaller biotechs, which, may end up in some case being a better investment, but you don't know because they have drugs in development. If they work, they become super valuable. If they don't work, the company fizzles out. Whereas, Merck, Pfizer, Lilly, that group of stocks, they have these huge portfolios of drugs and they make a lot of money off them and generally pay dividends as a result. So it's that kind of connotation.
Speaking of some of the flash in the pans, something super hot topic-ish is meme stocks. So how exactly would you define meme stocks? Because to me, it's viral popularity with social media and social engagement. That's kind of how they got their boat to float in the ocean. But I know that from a trading perspective, you may have a different idea.
Well, this one's actually a relatively new term. The term really didn't exist until about 2 years ago, 2021, when the term sort of caught fire. It was because these stocks all had a huge following on social media. There is no established definition for them. For the most part, it is just because they get talked about on social media and their following can be quite passionate. The best definition, I'm actually going to credit my son for this one, and he said that the meme stocks to him had all that social media component, but also an element of nostalgia. Because there was there was sort of this idea that, oh my gosh, how can these companies that were so important to us when we were kids be in any sort of trouble? And that includes GameStop, that includes AMC, it included Bed Bath & Beyond, which is no more. The list included things like Nokia, BlackBerry, Build-A-Bear Workshop. So I think it's interesting. Tupperware kind of came and went recently as a so-called meme stock, but that's another one that's got an element of grandma bringing the cranberry sauce.
Absolutely.
In
or
a
the
Tupperware
parties.
Yeah, exactly.
All the millennials definitely, I think, felt some level of nostalgia with those, which now those once kids have some money and some interest and said, let me look at these a little bit deeper. And I agree, when you add an element of something that's intangible like nostalgia, it could push somebody sometimes to want to invest further.
I think that's what made them morph from just sort of curiosities to having this fervor behind them. There was a lot of passion behind them. And unfortunately, the term also became associated with a lot of unrealistic expectations. And I don't want to dwell too heavily on it, but I think, that's because ultimately it became sort of a sideshow, and it did not end well for many of the people involved. Especially again, we've got AMC near all-time lows and Bed Bath & Beyond literally going out of business, and people actually arguing with me to the end when I was saying that it was very clear that the stock, and this was by analyzing bankruptcy proceedings and stuff of that nature, that there was really no value left for shareholders. I'll let you explain bankruptcy in a different podcast, how that works. And then people arguing with me, yes, it does. And at some point, because they were just impassioned. And I guess one of the lessons to take away here is passion does not replace fundamentals in the long run. Combination of social media and nostalgia is what led to that phenomenon.
Yeah. The next one was something new that I didn't totally know of, and that was the dogs of the Dow term, which I was talking to you about earlier. So that was about the highest dividend yield stocks within the Dow. I never heard that before. Have you been exposed to that phrasing a lot?
Yeah, I mean, it's an older strategy. I'm not a huge fan of the Dow Jones Industrial Average as a market barometer. The reason for that is a little bit of history, if you'll indulge me.
Sure.
The Dow Jones was created by a man named Charles Dow, and I guess he later had a partner, Jones, and they then founded the Wall Street Journal and other things. But in the 1800s, they wanted a way to measure the stock market, and so he put together sort of the 20 most important industrial companies, the blue chips of that era, as it were, and wanted to calculate some measure that that put them together. But his technology was pretty much limited to a pencil and paper and someone who could yeah, but maybe that worked better in Japan and in China, but not. I don't know that he had access to the abacus. So basically, it had to be something that could be done, relatively quickly. So he did what he thought was the right thing to do. He took the average price, basically added up those 20 stocks prices and divided by 20. And there was your Dow Jones average. It later became 30. He added industrials, transportations over time. The concept, I get the concept, but now that we live in an era of computers and we don't have to do that, it's a relatively poor measure because it's price weighted. And remember, I just said that price doesn't necessarily represent value. So a stock, whatever the stock is that has the highest numerical price, has a higher weighting than a stock that has a lowest numerical price, which can be very arbitrary. And so most other indices that you see, the NASDAQ 100, the S&P 500, et cetera, they're weighted by market capitalization, which is the stock price times the number of shares outstanding. Then you sum those all up and average them. And there's a divisor, et cetera, because the stock split and things of that nature. So that tends to be a more widely accepted and robust calculation. So getting back to it, the dogs of the Dow would be, you would take the 30 stocks that performed. You could look at it one of two ways. You could find the 10 stocks that have the highest dividend yields. You could assume that, if the way the dividend yield is calculated, if a company pays out X in dividends, you divide that by the share price that you've paid for the stock, that's your dividend. So if the stock's dividend has remained relatively constant or even risen and the price has fallen, its yield has gone up. And so you could buy the 10 stocks that have the highest dividend yields because you could argue that they've underperformed. The other way that I've seen it done is you just buy the 10 stocks that have performed the worst and potentially sell the 10 stocks that have performed the best. And over time, those may revert to the mean. I prefer the dividend one a little bit more but dividend yield, because stocks don't always revert to the mean. Stocks are not necessarily a mean reverting process. So they can go up or down without reverting to whatever mean or average you're talking about. So that's a long way around. I think it's a neat strategy. It's been around for a while. There must be an ETF that's attributed to it because there's an ETF attributable to pretty much any strategy we can come up with.
So the next two fall a little bit similar. So it's, of course, the dead cat bounce and short squeeze. So talking about dead cat bounce, which is like that short live, and then right down the roller coaster, and then a short squeeze. I'll let you explain these because these are obviously super popular in financial media and financial journalism. I see them all the time. If there is one topic that you have to talk about, everyone asks you about when you work in financial services and you go to a dinner party, it's what is shorting? What is a short squeeze? People hear about it and they don't understand initially because it seems easy, and then you think about it and your brain hurts. So I'll let you take this one.
Let me separate them out. Dead cat bounce is just, sort of trader's dark humor. A stock is falling and eventually it finds a level where it stops falling, and then it might actually lift up a little bit. And that's sort of the term dead cat bounce. Obviously, the traders that came up with this were not PETA members.
Right.
I don't know exactly how long the term's been in use, but it's been in use for a really long time, which of course leads to the corollary where a lot of traders will say, well, dead cats don't bounce. Leaving the imagery aside, the rationale behind it is markets overreact. They typically do in both directions. And so in theory, if enough people get panicky and sell a particular stock, it may get sold down to the point where probably shouldn't have been pressed down that far. And so you get buyers stepping in to buy it. And of course, that turns it around and it bounces a little bit. So that's where the term comes from. It's completely not scientific. It's completely rooted in,
just falling and hopefully bouncing a little bit.
Exactly.
Right.
Dark humor and hope.
Right.
So short squeeze is a more important one and a trickier one. I guess it's important to understand what selling short is before I explain what a short squeeze is. But when you buy a stock, your intent is to buy low sell high. So you buy the shares, you hold on to them, they go up in price, and you sell high. That's the goal. Doesn't always work that way, as we know, but that's the hope. The hope for a short seller is to sell the stock high and hopefully buy it back lower. Well, how do you do that? How do you sell stock that you don't own? That's, first of all, the term for that is selling short. What you do is, since whoever's buying the stock expects to actually get shares, your broker will go out and borrow those shares on your behalf. They will often charge you a fee for that because anytime you borrow things, there's a fee associated with it. We explain that elsewhere in IBKR campus, so I won't belabor the mechanics of that. The seller borrows shares and, hopefully tries to buy them back later. And there are some specific risks when you're selling short. When you buy stock, if you have enough cash, it's yours. You own it. It goes up, it goes down. That's that.
It's still yours.
It's yours. If you buy it at 20 and it goes to 40, fabulous. If you buy it at 20 and it goes to 10, that stinks, but it is what it is. In the case when you sell short, the borrow rate is a variable rate and can be a very, very variable rate. And it also assumes that there are people willing to lend the stock. Now, we have a whole department of people whose role it is to facilitate these borrows. And quite frankly, again, because there's a fee associated with the borrow, this is a facet of our business. But that rate can change. So if you have very high demand for a stock to be shorted, it gets increasingly more expensive to borrow. And at some point, you may not be able to find the stock to borrow, or whoever was lending it to you sold the stock. You don't know who's lending it to you. It's done through the middleman, but whoever's, let's say our stock loan department finds someone who has 100,000 shares of stock and we lend that stock out to customers who've shorted 100,000 shares. If that original customer who was long it says, sells out of their 100,000 shares, our stock loan department has to scramble to find 100,000 shares for the customers. They may not be able to do that at a very attractive price. They may not be able to do it at all, in which case it becomes incumbent upon whoever shorted the stock to go out and buy it back. Also, because there's a loan involved, if the price of the stock, in the case where I said if the stock goes from 20 to 10, if you've bought it and you paid cash for it, you're out, but it stinks. In the case of shorting stock, there's always a borrow involved. And so let's say you've sold the stock at 40. Well, that's collateral against the stock you've borrowed. What if the stock goes up to 60? You have to post more collateral, or you can't borrow it and you're forced to cover. And if enough people either can't get the stock or it starts to go up and it becomes too expensive for them to be short the stock, or the demand to short it becomes offsides, that's when you have the short squeeze. And those can cause big rallies in stock prices in a very, very short period of time.
Right. That's what causes those rises. So the quick definition, I guess, in a way, is those people who did buy the shorts, they're starting to buy stock now to limit that loss.
The people who sold it
short, I'm sorry,
are
right.
forced to buy stock to limit their losses, whether to minimize the amount they're borrowing, et cetera. And they're forced to buy this stock. There's a feedback loop because as the stock goes up, it induces more people to have to cover. And that's where, and now the problem is these tend to end abruptly, violently. So, it's a little tricky because a lot of times it's if you're seeing the stock rise because of this, it can be pretty seductive because you say, oh, this stock is zooming. But once that source of demand dries up, the stock often comes back to earth. And also bear in mind, there's a reason why a lot of people, why in a lot of times heavily shorted stocks are heavily shorted, because there is a fundamental mispricing in the stock. They are overvalued. But the problem is it's a lot easier to exploit a stock that's undervalued because, again, you're assuming you paid cash for it, your risk is defined. You buy the stock and it goes up or down, than it is you're stopped out at zero, basically. Right. In the case of a short squeeze, it's harder because you're always using borrowed money and there's no limit to how high the stock can go, right? If you buy it at 20 and it goes to zero, you lost 20. If you sold it short at 40, There's nothing that says it stops at 60. It can go to 80. It can go wherever. And so these become very, very treacherous and unstable situations. And they came into the fore as a result of the meme stock phenomenon because a lot of fundamental investors saw that these stocks were overvalued. But there's another saying, and this is for the one when we actually do sayings, markets can remain irrational longer than you can remain solvent. And so that is the risk. And so the term short squeeze is not new. I think there have been short squeezes for as long as there have been shorts.
It's definitely been popular since the meme stock headlines.
I will say social media has learned to weaponize it in a way that whereas before it was just one set of professionals trading with another set of professionals. Now it became a bigger part of the common parlance, a bigger part of common psyche.
So now it's a little bit more Main Street talk than it was just Wall Street for a while.
Exactly.
That kind of goes perfectly into my next two, which are two things that I remember learning very early in maybe 4th or 5th grade, and that is panic selling and bubbles. So I remember learning about the Great Depression and people panic selling different things or pulling all their money out of places and different bubbles popping. I was in school when the 2008 real estate bubble happened. Both of those are on the negative side. We'll go to the positive one after. But what from those, from the panic selling and the bubble, would you kind of work together? Would you say they work together?
They're opposite sides of the same coin. They're when people become irrational in one direction or another. Unfortunately, the bubble usually leads to the panic,
right?
Which is what I said before. Things overshoot. I mean, that's grossly overshooting on a macro level. But it's when rational decision making gets replaced with visceral behavior, with emotional behavior. So, in the sense of a bubble, they start out as something generally quite positive. Some asset is going up. Real estate is going up. Markets are going up. It looks great. But at some point, and it's easier to tell this in hindsight than in real time, it flips from constructive investing to somewhat of a mania. In the case of the global financial crisis, we had the real estate bubble was one part of it. Real estate was appreciating. That's a good thing. If you're a homeowner, if you don't own your home, that's a problem. But, considering the majority of people are homeowners, most people really liked it. Well, as the prices of real estate got more expensive, I would say there were a range of financial institutions that got a lot more creative about how you would finance your purchases. And I won't step on the home ownership podcast that you've done, but let's just say, for argument's sake, in a standard mortgage, you put down 20% and you borrow the rest, and you have to meet lending standards. Well, in the early 2000s, those lending standards decreased and decreased, and the amount of money you would have to put up decreased and decreased. So you could buy homes for almost 0% down and finance the whole thing, and ultimately, that becomes a fragile and somewhat unsustainable situation. Well, then what happens? So then the prices start to come down. Those who made those crazy loans basically go out of business. And that sets off a chain of panicky people in the other direction. And so, that's overshooting in a grand sense. But they're two sides of the same coin. It's when rationality is replaced by emotion. In chasing something, and people, when they're emotional, tends to breed irrationality. And I will say, having lived through both bubbles and crashes, the crashes are worse because people. One thing, if you give back paper gains, you had something that was worth, you had a house that was worth $250,000. It was worth $500,000, but you had no place to move to anyway, and now it's back to being worth $250,000. It sucks, but
you still have a house.
You still have the house. But in the case of, if you got foreclosed on because you had some mortgage that you couldn't pay off or afford, and you had the house that you were the one who paid $500,000 for, you're out. You're out, and people react very, very poorly. And that's why I think that's why I think it's important for anyone to listen to this. You can't go in over your head with investments because they don't always work out. And at least you want to be in a situation where if it didn't work out, you're not, no one investment decision has you risking it all or has you risking too much. Over time, one of my friends wrote a book about this. A lot of what he's found, the best investors are risk averse, not risk takers, because a lot of times it's not if you lose too much, you can't get back in the game.
That's kind of like with the saying of the reason that some people are wealthy is because they didn't go out and spend or risk all of their money.
Exactly.
Right.
Exactly.
Right. Because they sometimes keep the wallet close to the vest.
Mm-hmm.
But if we were to go to the positive side,
sure,
let's switch it up, make it a little bit more on the positive side. Another piece that a lot of people hear, especially with risk-averse type investors, is the word safe haven. From what I know, something that's a little bit more of a risk-averse security or something more established. But if you were to name a few things off your head that people usually coin safe havens, what would those be?
Cash and cash equivalents tend to be your standard safe haven. There is no true safe haven. Let me say that.
No investment is guaranteed to be safe.
Or even if you have something like U.S. Treasury bills, which have a flawless record of paying back over time. Even there, if the rate of inflation is greater than the rate of money you're earning, your purchasing power over time suffers. But the idea of the safe haven is that you're pretty sure you're going to get back out of it, at least in nominal terms, what you put into it. So the old joke is the ultimate safe haven is the Sealy Posturepedic.
Oh, right, exactly.
Cash in the mattress.
Yeah, the cash padded mattress, exactly.
But realistically, in a more realistic sense, it's, as I mentioned, short-term treasuries.
Like treasury bonds?
Treasury notes.
Like that.
Yeah, treasury notes, bonds. The U.S. Treasury has at least so far,
usually, fingers crossed.
I don't know if you heard me knocking wood there, has a flawless track record of paying back people the dollars that they're owed. CDs are in many senses a very good safe haven. Boring. Now, the thing is, safe havens are boring. Let's be real.
Right, exactly.
But CDs, if you are below the FDIC limit, which is currently $250,000, the government is backstopping the CD of the bank. So effectively, they're government protected securities. And so those are very safe. Savings accounts, checking accounts. Again, none of these are exciting.
Right. None of them look illustrious or are super exciting for you to talk over dinner with your friends. But that's the point.
Exactly. Now, if you want to extend it a little bit, let's say within the stock market, your safe havens tend to be stocks that are less volatile or have steadier earning streams. Utilities, for example, are considered safe havens. Because ultimately everybody needs to turn on the lights. It's one of the last bills that people skip. They're regulated industries, so there's a certain profit that they can make by state mandate, but they're also pretty much guaranteed to make a profit under most circumstances. There are outlandish ones. Recently, Hawaiian Electric, the stock got pummeled because as we're taping this, it's not clear whether they are or are not to be contributing factors to the wildfires in Maui. But for the most part, utilities are considered safe havens because they pay a nice steady dividend. They earn pretty much a straight amount of money, and they tend not to move as much. Compare that to, let's say, I gave the example before of a biotech stock where the risk reward is enormous. And so safe havens, generally speaking, bonds tend to be more of a safe haven than stocks. Certainly highly rated corporate bonds tend to be better than lower rated junk bonds. I think that's kind of endemic in the term there. And that's the way to think about it. Safe havens are relative.
You still have to do your research on everything. And like I said, no investment is perfect or safe. But when we look at the broader economic scope, there are three things that are super common in today's financial news: hawkish versus dovish monetary policy, and then stagflation. So I hear those with the word Fed somewhere in the same sentence based on my job at least once a day. How would you talk about the hawk versus the dove and how stagflation impacts the economy from a wider scope?
Well, The Federal Reserve and central banks in general, so if you're listening to this in Europe, it's the ECB. If listening in Canada, it's the Bank of Canada, et cetera, et cetera. But we're going to use Federal Reserve because we're sitting here in the US, and it's the biggest of the central banks. Central banks influence the economy through monetary policy. In the case of the US Federal Reserve, it actually has what's called the dual mandate, and that is stable prices and full employment. The problem is they don't always work together. A lot of times when you have full employment, it leads to inflation because you have to get people employed and they're going to hold out for more money. On the flip side, if you have stable prices, it can generally mean that the economy stinks and people are losing their jobs. So they have a tricky balancing act. The ways they do this are through interest rate policy and through buying and selling securities on their balance sheet. Again, we'll leave the full mechanics out of this. It's also important to remember that inflation is the rise of how much prices are rising over a given period of time, whether it's monthly or annually. Can I get mathy? I mean, basically, if you have there's an index, the CPI, the Consumer Price Index, and that's an index of how much they calculate this basket of stuff will cost. Inflation is the change in that basket, how much it goes up or down over the course. So that's really your first derivative of prices. And so stagflation describes a situation where there is inflation, but the economy is stagnant. That's kind of the worst scenario given the dual mandate that I gave you, meaning that the economy kind of stinks and we have inflation. So it's essentially the Fed is kind of failing on both of its mandates.
So it's rough out there when that gets used.
Yeah, you really don't want it's not a great situation most of the time. When central banks are stimulating the economy, lowering interest rates, basically making money plentiful, to adding money into the system, that's considered a dovish policy. When they're fighting inflation, raising rates and doing other measures to sort of reduce the amount of money that they're putting into the economy, that's called hawkish. So generally you're fighting inflation when you're hawkish. When you're dovish, you're generally stimulating the economy. Those terms, again, I look back at those they actually do have some precedent, not even beyond like a market precedent. They go back to like the 1700s. Hawkish, because you also hear the term hawkish referred to in military policy. Are you hawk or a dove? Are you militaristic or are you more peace-loving?
Right, yeah.
And so that, I think, morphed into, into central banking. So hawkish is when they are when the policies are designed to take a little steam out of the economy and out of prices, getting inflation to stay stable. Dovish is when they're willing to put money into the economy, lowering rates to get the economy stimulated.
I kind of think when I was learning this when I was studying for my Series 7 was a lot of times in most art, you see doves with an olive branch. They're bringing you something. It's peaceful. Hawks usually come down and take away their food. They swoop and take it away. So I think of the money giving and taking in those policies. But initially, someone might say, what do birds have to do with me trying to get a home? And that's why we bring this up today. So we covered a lot, but what are some other important items that you think would be important for our listeners to pay attention to? I know doing your research is important, but from the perspective of a reader of financial news, a writer, we'll say a talking head on a lot of shows, what would be your kind of advice to people as they go through seeing all this jargon as they start off their investment journey?
First of all, keep a level head. Remember, I think if you keep a level head and keep an eye on, and I think it's also important, I think ultimately it's more important to focus on your risk than your return. It's very easy when you're investing in stocks to think about how much money you could make and at the expense of thinking how much you can lose. And as I alluded to earlier, a lot of really successful investors don't think that way. They think about the balance between what they can make or what they can lose, and actually are more really try to avoid situations where they're prone to lose a lot of money. They're not necessarily big risk takers. Or if they are risk takers, it's under very prudent circumstances. And so I think that's really the way you should approach a lot of this stuff. It's very easy, particularly if you're engrossed in social media or talking with your friends, like this stock's going to double, it's going to triple, why? Based on what? And if it doesn't, what's going to be the outcome? What are the odds that this stock might triple? Is it more likely to just do nothing? Is it, more likely to go down? Who is telling you that it's going to triple? Is it somebody you know and trust, or is it just some loud voice who gets a lot of publicity? And these are the type of things you really have to keep in mind. You said do research, but the question is where? And I think, going to Reddit is not doing research. Finding out some places that, are trusted sources, and I like to think that IBKR campus qualifies as one of them. We are one of them. We're not the only one. Our goal, you may say, oh, well, we just want people investing. Yeah, we do. But we want to keep our customers, especially the people who are listening to this podcast. We'd like to keep them for customers for 50 years, potentially. We don't want you to blow up. We don't,
We want to offer you a way to educate yourself as well on what the products actually are and give you an understanding or the potential to learn further about how the mechanics are, as you talked about earlier with shorting and so on and so forth. You can't just look at a few phrases that you saw online 10 times and assume that the jargon is always positive.
The harder the sell, the more the hair on the back of your neck should go up, the more wary you should be. And that goes for anything. Why is this person selling this so hard? If it's a good idea, if it's a good purchase, a sensible, educated approach will generally work. What are the advantages of this stock, this product, this computer, this whatever? If it has real advantages, you could be told them in a very rational manner and decide for yourself if those things are important to you. If you're being told this is the greatest thing since you got to buy it now, that should make you a bit nervous. That should make you step back.
Use your head.
Yeah.
Think about it a little bit more logically. And while these terms have been around for a long time, anybody can technically use them in whatever connotation they want. Mm-hmm. So definitely good, as you said, to make sure that your sources are accurate as well. So thanks for joining us and talking about jargon today, Steve.
My pleasure, Cassidy.
And as always, listeners can learn more about an array of financial topics for free at IBKRcampus.com. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening, everyone.
Thanks for listening to IBKR's Sense of Security. As always, there's more content at IBKRpodcast.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education content such as webinars, market commentary, market-related courses, and quant-related articles at IBKRcampus.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.